Welcome again to Financial Freedom Fridays. I'm your host, Gus Tucker, and I'm excited to be here with you today. We're going to be looking at, now we've moved from, in our masterclass, from concepts to actually execution, okay? We moved from concepts to execution. So we're now, phase one of the execution was one, financial education, which you've been getting, and two, developing a relationship with a financial professional, either myself or somewhere else who can help you navigate through this. Because today really starts moving from knowing what to do to actually doing it. Because if we don't execute, we don't get the benefit of our knowledge, right? You know, people say knowledge is power. It's not. Knowledge applied is power. And knowledge applied consistently and persistently is the greatest power. So we're going to get started here today, get this slide going here. So we're talking about proper protection, going from knowing to doing, okay? Now we're going to a quick review. Financial independence, what is it? It's having a sufficient personal wealth to live without having to work actively for basic necessities, where you've got enough money coming in. You have enough money coming in where you don't have to continue to work. You don't have to continue to work for your money, okay? And literacy is competence or knowledge in a specific area. Financial literacy is understanding how to earn money, spend money, save, manage, and invest money. And once you learn this, you'll be forever free, okay? So financial independence is made possible by applying financial literacy, okay? So now is application time, guys. So we talked about this. Go to the website, take the quiz. HowMoneyWorks.com, Gus Tucker Challenge. Take the quiz, send me your score to this email. And a couple things you're going to get. A couple of them are blocked on the screen. You're going to get a financial freedom checklist to make sure you're covering all the areas. And then you're going to get a financial needs analysis form to begin to populate that with your numbers so we can put together a plan. Either myself or someone else can put together a plan for you, okay? So here we go. The book, How Money Works. You want to get that, you have to study it, and you have to apply it. You have to study it, and you have to apply it. We talked about your reasons and experience for financial independence. You need to have reasons why you want to be financially independent, because the road is not going to be without its obstacles, okay? You're going to have ups and downs, and if you don't have strong reasons why or strong feelings about it, about why you must have it, why you have to have it, it's not going to happen. Because you'll quit along the way. Most people do quit. Okay? Quite frankly, most people do quit. Everything they start, you will not be a quitter. You're going to finish. You're going to finish, okay? You got to create your financial independence 3 times. The first time in your mind, the second time on paper, and the third time taking your written plan and making it happen. And that starts right now. Having a written plan where you have on paper what it is you're trying to do and when you're trying to do it. A dream, a dream without a goal and a date tied to it is really a pipe dream. Okay? Your dreams need to have goals attached to them and dates attached to them, or it's a pipe dream. Okay? Not a real dream. Okay? So, I know your zero-based budget's complete. I know you've already done it. You know your spending habits, your saving habits, your investing habits. I know you already got that budget done. It's already locked and loaded. And now we're ready to make things happen by applying it, okay? Again, you've read the book. You got your 10 reasons and feelings. You completed your zero-based budget. You know where your money's going. So now we're ready to rock and roll. And step 1 of the plan has been completed. You started your financial education, found a financial professional. Step 2 of the plan today is developing a plan for proper protection. Proper protection. What does that mean? Here's what it means, guys. We talked about the 7 money milestones. Proper protection is protecting against the loss of income or against the loss of savings. Protecting against the loss of income or the loss of savings. Gus, what are you talking about? What are you talking about? Well, let's read these statements. The protection of a man's person is more sacred than the protection of property. For most of us, the biggest asset we have is ourselves. If our ability to create income goes away, our family is not going to be taken care of. Because until we get to financial independence and there's enough assets, so whether you're there or not, the money's coming in, we're the biggest asset. Okay? Now think about the assets in your life right now. You have a house. Does the bank require you, if you've got a mortgage on the house, does the bank require you to have insurance on it? Sure. And even if the house was paid off, would you keep insurance on the house? Yeah, in case it has a fire or burglary or something happens, you want that house to be replaced. You wouldn't want to take the risk for the cost of some homeowners insurance that something would happen to your house and you wouldn't have a place to live. So you pay for the insurance. Your car. Do you have insurance on your car? Well, yeah. Why? It's a state law. Because you might hit somebody or somebody might hit you, and you want the medical bills to be taken care of, you want the car repair to be taken care of, so there's insurance on that accident. But we don't look at our lives the same way. But I want you to protect your income and your wealth with life insurance. Protection of your financial assets is called life insurance. What? I thought that was protection on my life. Yeah, but check this out. If you can't work or create income, what's going to happen to your house? Probably lose it. What's going to happen to your car if it's not paid for? Probably going to lose it. What's going to happen to your retirement savings if you don't have insurance? Well, your family's going to lose it. They're going to have to use that money to live on. Then it's going to be gone, and you're probably out of luck. So life insurance can be a defensive strategy motivated by a sense of love. Life insurance is only for families that love their fellow family members or they're responsible people. So if you're irresponsible and hate your family, don't get life insurance. But if you love your family and you're responsible, you should have it. Okay, now let's talk about it. How much? Proper protection to build wealth. This is Dana. Dana says, how do I calculate the amount of insurance I need? Is there a rule of thumb I can use as a starting point? Okay. Here's one rule of thumb. It's called 10 times your annual income. If you earn 50 grand a year, you should have 500,000 in coverage. If you earn 100,000 a year, you should have $1 million in coverage. Why is that? Because if you passed away, how many years would your family need the income that you make to live on? Well, it kind of depends. It kind of depends. But I want you guys to get a piece of paper out right now, okay? Once you get a piece of paper out, let me know. Somebody let me know when you got your paper out. Somebody let me know. I got my piece of paper out. I got a pen. I'm ready to go. And on your paper, what I want you to write down in a column is DIME. D-I-M-E. D-I-M-E. Okay, just like that. Down the side of the paper. You see that? Down the side of the paper. D-I-M-E. D-I-M-E. Gus, what's that for? Okay, here's what it's for. D. The D stands for a couple of things. One is death. All of us are going to pass away. Guaranteed. Mortality rate in America is 100%. Okay? So, do you want your insurance to pay for your funeral? How much is a funeral? Man, I don't know. How much do you want to pay for a funeral? As little as possible? Maybe 3,000, 5,000. You want to have a party? It's going to be more. So how much do you want to pay for your funeral? And remember, if it's in the future, because of inflation, it's going to be more money. Okay? So D is for death. The other D, you see it right here on the screen, is for debt. How much consumer debt do you have? Credit cards, automobiles, student loans, personal loans. What's that debt number? You want to pay that off before you pass away? I would encourage you that you should. Don't leave that lingering. Pay off your debts. So D is for you're paying for your death. You're paying for debt. Okay? I is income. How much do you make gross per year? How much do you make? Write that number down. Now, how many years is somebody going to be dependent on your income? A spouse, right? Those dependents, a spouse. Not your spouse is a dependent, but a lot of people, when they built their incomes, they built their budget. That zero-based budget you did, you built that budget is based on two incomes. Okay? So how long is your spouse or your children going to be dependent on your income? As spouses, we can live into our 80s. So when I'm sitting down with the family, I usually ask the spouse. I ask this spouse to be quiet because they're dead, so to speak. And I ask the spouse, how long would you want their income to come in for? And they'll tell me. Then I ask the other spouse, how long would you want their income to come in? And they tell me. And we write that number of years down, times how much you make, and you get a number. Okay? Then you look at your kids. Typically, kids are going to be dependent on you somewhere between 18 years of age and 25. Somewhere between 18 and 25, they're going to be on their own and be okay, probably. So how old are your kids now? And when you plan on them being on their own and out of your pocket? Multiply your income times that number. Okay? So D is death and debt. I is income for your dependents. Income for your dependents. Because one thing life insurance does is secure the bag, so to speak, the money you're bringing in. M is mortgage. What's the mortgage on your house where you live? And if you have rental properties or commercial properties, do you want those paid off or not? You can decide. But M is mortgages. M is mortgages. Okay, you got that number? Okay, great. So death and debt, income, mortgages. E is a couple of things. One, kids' education. Where they're going to go to school. How many years is it in the future? Historically, education has grown at about 6% a year, the cost. So every 12 years, the cost of a college education doubles. It may have changed now since the pandemic, but how many years do your kids go to college? How much is that school going to cost? And what percentage are you going to contribute? Somewhere between 0 and 100. So you figure out what the number is of what it's going to cost for 4 years. Take your percentage, multiply it by that, boom, you got education. Let's say it's going to cost 40 grand a year. 4 years is 160. I'm going to pay half. That's 80 grand. Okay, you got me? So dime, death and debt. I is income, M is mortgage, E is education. The second is estate. Estate. Well, what do you mean by that, Gus? Well, how much money would you want to leave to your kids if you could? Or your grandkids? Or anybody? What kind of lump sum would you like to leave them? Let me ask you a question. When significant people in your life died, whether it was parents, grandparents, would you have liked to have had them leave you a lump sum? How much would really help you out when they passed away? If you think back, mom or dad passed away, grandparents passed away, a favorite aunt or uncle passed away. Man, if they just would have left me X, man, that would have been helpful. What's that number? Write that number down. Now, this last number is optional. It's called retirement. Retirement is how much money would you expect to have saved if you lived to full retirement. If you passed away now, how short would you be? You want to make up that difference. You can say, Gus, I already captured that in my income. Okay, that's fair. Or you want to have a separate set aside for that. It's up to you. So you add that up, D-I-M-E, and then R. I'm curious if there's anybody out there listening, okay? And are you surprised by the number that you came up with? So if you're surprised, put in the chat. Yes, I was surprised. No, I wasn't surprised. So first thing is, yes, I was surprised. Now think about how much life insurance you actually have right now. Think about the amount you actually have and think about the number you just came up with. And I want you to put in the chat, did you have an equal amount? You had more than you needed or less than you needed, okay? So figure out the amount, DIME, debt. I got this much of credit cards, card notes, student loans, debt. I'm going to pay this for my future. Income. Here's how much money I need to take care of my wife and kids or any dependents I have on me. M is to take care of the mortgage. E is on my estate, what I want to leave people. E is education, what I want to pay for the kids. Total number. If you look at retirement, here's how much I would hope to have saved by retirement that would be cut off if I weren't able to retire because I was passed away. What's that number? And you come up with a number. Boom. Now, your current amount of insurance, is it equal to that amount, less than that amount, more than that amount? Let me get some feedback, okay? Let me get some feedback from somebody about what number they came up. The number was higher, lower, or dead on the numbers, okay? Had you ever even done anything like that before where you figured out how much life insurance you ought to have? I have to admit, 10 times your income is more coverage than I thought I would have guessed. It's got to be expensive, right? Two assumptions. One, man, I never thought I needed that much. Man, it must be expensive. We can typically work with any budget and get you close to what you need, if not exceed it, and not break the bank doing it. So I'm guessing the amount of life insurance you need and cost depends on your individual financial future. Great, sounds good. Like one of it depends. Answer. Excuse me. And it is. Your financial professional should discuss these questions. What are your short-term and long-term debts, loans, and goals? How much is your mortgage? How old are your children? How much will the education costs be? Do you have any assets to help cover funeral costs like an emergency fund? The things we just talked about. Okay? So, love to get some feedback from you guys on so far. Life insurance, need, cost, assumption, paradox. The same people who underestimate how much life insurance they need tend to have a tendency to overestimate how much it'll cost. So people get scared, right? They think it's going to cost too much. And then they underestimate how much they have. Check this out. Only 59% of Americans have life insurance. And about half of those are underinsured, meaning they don't have enough insurance. That's an overall statistic. If you're a person of color, do you think that number is higher or lower? In other words, a higher percentage have insurance or a lower percentage have insurance in our community? In the black and brown community, what do you think? What do you think, guys? What do you think? Let me know. I'm guessing the amount of life insurance you need and the cost depends on your individual financial picture. Yep, it's one of those dependent answers, okay? Now, there's two kinds of insurance. There's temporary insurance and there's permanent. Temporary insurance is permanent. At the end of the day, those are the only two kinds of insurance there are. Temporary and permanent. Temporary, called term life insurance, provides protection for a specific amount of time. So you buy the term, it starts on this day and it ends on that day. And while you're between those two dates, you're under the umbrella. You're okay. But when it's over, when the term is over, when your lease is up on the insurance, when your lease is up, what do? You either can convert it to a permanent policy or you're just out of luck and you'd have to rebuy the term insurance. But at that point, it's very, very expensive. Very, very expensive. Almost 2 times what you're paying now. Instead of $3,200, it's over $3,000 when you retire. If you can afford to do that, great. But if you can't, there are some other options. With term insurance, it's possible to secure a substantial amount of financial protection for your family or business with a relatively small amount. That term insurance starts out really, really inexpensive because it's based on your mortality rate, the probability you're going to die, right? and then they price you accordingly. The higher the price, the higher the probability you're going to pass away. The longer the term of the term insurance, the higher the price, the more likely you're going to pass away. Okay. But I encourage you to look at term insurance, get with your financial professional, and figure that out. Whether, and everybody probably should have some term insurance. I would say everybody should have some. It's just a matter of whether that's it. Permanent insurance is like you see in the picture. Folks are out doing something, whatever. Something comes up, man, they're scared. Man, I'm going to meet my maker. I need to have my stuff in order. Man, I need life insurance. Well, during the time of a storm on the water, you need to know how much life insurance you actually even need. So we need to figure that out, right? We need to figure that out. So what happens when the term ends? What happens when the term ends? So let me see if I can back up here real quick. I'm gonna back up. So what happens when the term ends? If you no longer need insurance, your kids are grown and independent, their education and your home is paid off, all your financial responsibilities have decreased. Well, you don't need a term policy, you can let the policy end. That's it, man. I'm glad you were able to cover me during the time when I really needed it. I have the policy. I don't need it anymore. But guys, term policies are set up statistically so they're probably not going to pay out. Okay? They're probably not going to pay out because the insurance company wouldn't make any money if the term policy paid out. So it's statistically set up that you probably won't need it. But the question is, are you willing to take that risk? Because some people will need it. So what happens when the term ends and you still need term insurance? Why? I still got a mortgage. I'm a single income couple and I really need this other income, coming in. So if they pass away, I'm kind of screwed. I need some more income. I got grown children, grandchildren at home. It's starting to cost me more money. So what do you do? So one of the things you want to do is look at this X wave. And the reason it's called an X wave is because you've got a passing of responsibility in wealth. So early on in a family, when it's a young family, you probably need more responsibility, more insurance because you've got little ones you're concerned about and you got a spouse. But as you get older, your kids move out the house, they've got their own jobs, they're good to go. You're not as needed for the family financially. Same with mom. As mom goes out when the kids are younger, if she chooses to do that, and works, as the kids get older and they're in school till 1 o'clock or whatever, you don't need to be home, stuck in the house, etc. You can get a part-time job. Okay? Now, permanent life insurance, you buy that for your entire life. You buy it for your entire life. And it also has a feature on it called long-term care. Long-term care, which is a product that if you purchase it on a standalone basis, you pay that money to an insurance broker, my wife, or one of the persons on the team, if you so choose, to do business with us. Otherwise, that permanent life insurance, what's going to happen with it is you can turn that term insurance into a permanent policy. It's called a conversion. Now, you can convert it at the age you are today, at the amount of insurance you have today, or you can convert just part of it. Okay, like term, it provides a death benefit to protect your family financially, and it's also designed to be kept for life, not just for a term. Okay, the other thing about this permanent life insurance policy, it's got other benefits other than just the death benefit. It's got 3 important benefits. One, life life insurance coverage for life. So no matter how you live, they're set up to run till you're 121 years old. Permanent life insurance is. Okay. Number two, it's got something called long-term care on it. What the heck is that? We'll talk about it in a second. And it's also got money in it. It's been building cash value inside the policy. It's money that you can use for something else. I just pulled some money out of a cash value life insurance policy to make an investment into something else. Okay, so you can use it like you would use a bank to hold on to your money, except better interest rates, and pull it out for an investment in something else. So what does permanent life insurance, what are some of the benefits it has? Zero market risk. There are policies, permanent policies that my clients have in place right now that paid 15% last year in interest with no tax and no market risk, because it's got a floor on it that if the market goes negative, the current position locks in and it goes back up when the market passes that position. So zero market risk. You can't lose money in the market. It's also got long-term care insurance. This insurance has a rider on it where you can add a long-term care benefit on it for virtually no cost. So what's long-term care? We'll talk about that in a second. Tax-free growth, as I talked about, that 15% grew tax-free. If it was in a Roth IRA and taxable, man, that's like getting 20% or more if you count the taxes on it. It's also a tax-free legacy. When you leave the money to your family, 99 times out of 100, it's going to be tax-free to your family. Some other reasons. What can the cash benefit value do for you? You could do things like buy cars, buy vacations, pay for weddings. I've had, friends of mine that had these policies with me, pay for weddings, pay for education, travel if they needed to. So those are just some of the ways it could benefit you. Tax-free growth, creditor-free. Many life insurance policies are free from people trying to sue you or collect debt from you. Zero market risk. It's never going to lose money. And it provides a tax-free income. Says, I get how life insurance protects me financially, but what if my wife or I suffer from Alzheimer's or dementia? Wouldn't the cost of a nursing home wipe me out? It would wipe you out because it's $7,000 or $8,000 a month to be in the better facilities. How long would your life savings or your life savings essentially cover you at $7,000-8,000 a month? It's $100,000 a year. And it says 70% of people over age 65 will need some type of long-term care. What does that mean? Well, whatever it would take you to go to church or go out on the weekend, all the things you'd have to do, be able to clean yourself, dress yourself, feed yourself, walk through the house, drive the car, have the mental capability to do that. If you couldn't do that, long-term care pays for someone to do that for you. And it says over 70% of people are going to need it. About 8% have all the money they need to be able to buy it. Okay? Long-term care insurance. We have several different companies that provide it. We have the best ones in the industry that are standalone products and products that work through a life insurance product like the one I'm talking about today. So if you wanted long-term care on a policy, we can help you get that. Average long-term care costs, adult daycare, $16,000 a month. Assisted living private, $48,000 a year. Sorry. Home health aid, $50,000 a year. To have someone come in That's $4,000 a month. Nursing home, 90 grand. Private nursing home, over $100,000 a year. If you pay for that out of the money you save for retirement, that's what I mean by proper protection to build your wealth. If you don't have to pay that out to long-term care if it happens, but you can keep that in your bank account and pay it with the life insurance policy, it's like double dipping. I've got my money for the long-term care and I've got my money for the retirement. Winding down, what kind of long-term care should you coverage? Traditional long-term care is a standalone. It's kind of use it or lose it. If you need it for long-term care, it's there. If you don't, there's probably a penalty or something attached to it, because long-term care is only for people who can afford, 3 to 4 months really, and they can afford to get started. Because the companies are cracking down on how we qualify for these policies. So you want to make sure that you get these things done as early in your life as possible. Okay, early in your life as possible before you can track things like, diabetes, high blood pressure, and things like that, which tend to run with people of color. So that traditional standalone policy, you get it that way, or a rider to a permanent policy, where you have a permanent policy, like I talked about, and it's got attached to it this long-term care benefit. Okay, for my mother, who lived with me for 15 years before she passed away, the first 10 or 12 years are fine. The last 3 years were pretty tough. We were her long-term care because I was an entrepreneur. I could stay home and help her. Okay, but that's something you want to think about. The last thing, there are some other living benefits that come on life insurance policies. What do I mean by that? Here's a story. One of the people on my team had a nephew. 7 children. Seven children. Guess how much life insurance he had on himself? 7 children. The wife didn't work. She homeschooled the children. 0. He had 0 life insurance on his family. So my friend was persistent and kept talking to them and finally got them to put in a term policy. Okay? For about $500,000. They were paying $60 a month or something like that, $70 a month for $100,000. Or for $500,000. Come to find out, a year and a half later, this person contracts cancer, stage 4. That's called a critical illness. Okay? And what's that for? Enables the insurer to collect a portion of their death benefit to cover expenses when diagnosed with the critical expenses like heart attack, stroke, cancer. We pulled out $440,000 out of that policy so the wife could do what? Live today. $30,000. $440,000 was pulled out the policy, right? And they were paying like $50, $60 a month for that policy. They had the policy for like 18 months or something, a couple years max. So you do the math. For a couple $1,000s, they were able to pull out $440,000. What did that allow them to do? Live in their house for the first thing, eat, took care of the family, also was able to take care of some preventative treatments or some special treatments to really help him with the handling of the cancer. He lived for 2 years and passed away. But how would the family have made it if he didn't have this policy? And he was 2 years before he passed away and had no life insurance. And the wife didn't work. How long could they keep going in that house? See what I'm saying about the critical illness and chronic illness like Lou Gehrig's disease, ALS, diabetes, Alzheimer's, things that are chronically wrong with you that wear you down and wear down your health over time. I encourage you to think about these 2 things. Critical illness, things can just happen with accidents, or stroke, cancer, heart attack, or chronic illness, something that's an illness over a long period of time that will end up taking your life. Wouldn't it make sense to protect yourself against that happening so you don't have to use your retirement funds to live on? With life insurance could protect your wealth. Okay? So develop your plan. Assignment. What's your assignment? Get properly protected today. Develop your plan for proper protection. Work with a financial professional. Use the DIME method or another method to develop it. Put your protection protection plan in place. Reach out for support at financialfreedomfridays@gmail.com. Take advantage of this time, guys, while you're alive and healthy. Get this taken care of, because day will come when you're going to be older and not healthy, and the insurance companies won't take you. So with that, get your protection in place. Take the financial literacy challenge. Get me your score, and I'll get you your financial needs analysis roadmap. Okay, guys. That's really it for today. Appreciate you taking time out to spend with us and to learn a little bit more about pure protection and proper protection. Term insurance, permanent insurance, long-term care. With permanent insurance, you can get the living benefits. You can also get the living benefits on a term policy. So that's same, which is what I was telling you about with the person who's the golf pro. They were able to leverage a term policy with living benefits on it to make it work for them. You can also do a permanent policy with living benefits as well. But that's what I got to share with you today. Have a great day on Financial Freedom Friday. This is Gus Tucker. Hit us up with an email, send us something in the chat. Let us know you're out there and how this information is hitting you. Take care. Bye-bye.